Hello friends, and welcome again to our video series where I update you on matters of markets, the economy, and the portfolios. Uh, the last time I came and spoke to you in June, markets were well on its way to recovering as the lockdowns were lifted. And in July and August, the markets continued to move up smartly, building on the gains that it had made in June. In July, the Nifty was up 7.5 and another 2.5, almost 3% in August. But I think what was interesting in the month of August was that the breadth of the market improved substantially. So the small and the mid cap index were up in the range of 8 to 10% in the month of August. And the number of advances to declines, which is a broad measure of how the breadth of the market is doing, also improved substantially. And if you remember the last time we spoke, I said that there are some challenges that we see in terms of the fact that the number of cases continue to rise, that there are selective lockdowns, which are still in play. But at the same time, there were certain positives like a very good monsoon, which has helped the rural economy to do well, and rural consumption has done extremely well. And we said that we should also look forward to more reforms and stimulus down the line. Now, as we stand here in August, I think the number of cases continue to rise. The selective lockdowns still continue, but we have now substantially opened up the economy at the national level. And to my mind, that should help the economy in the process of recovery much faster, because as you all know, that while June was very good, July and August, the recovery flattened out a little bit because of the selective lockdowns and challenges that we saw. And therefore, a progressively greater opening up of the economy should help in consolidating on the gains that most of the businesses had seen since June. And in my opinion, there were 2 or 3 other big important factors which we should discuss. One is that the Q1 GDP numbers were out and the economy has contracted by 23.9%, which, if you ask me, was a tad higher than what most people had expected, and also puts India amongst one of those countries where the contraction was the deepest. And therefore, that will bring challenges if we have to start recovering from such a large contraction in the economy. And in my opinion, the government will have to resort to some kind of stimulus in order to revive demand. There are a few steps that we are hearing about. I talked about the divestment last time, but divestment is a very, very complex job, and especially when you are trying to divest 2 assets in sectors which are most challenged. One is airlines, which is Air India, and the other one is BPCL, which is in oil and gas. It is definitely going to take time. And I think the government has progressively extended the timelines for both these privatizations. Secondly, the government is also focusing on Atmanirbhar or Make in India, essentially getting more and more sectors of the economy to be less import dependent. 2 of them are important. One is obviously electronics. So across the board, we have seen that policies have been encouraged for companies to start manufacturing mobile phones, TV sets, washing machines in India. That should give fillip to manufacturing in India, but that is still a very small sector relative to the GDP. What we are now hearing, and I think this has come. This was an expectation by the industry for a long time, which is there is some expectation of a GST cut on automobiles, especially two-wheelers, going into the festive season. And we are also hearing that a similar production linked incentive scheme, which was put in play for electronic manufacturing, may also be put in play for the auto component sector. Now, mind you, if that were to happen, it will be far more significant because India's automobile and auto component sector is more evolved than the electronic manufacturing sector. It's much larger in its footprint, employs a much larger base, and more importantly, I think India has a previous well defined track record of a globally competitive edge in the auto component sector. So if that were to indeed happen, and we will wait and see what happens over the next few weeks, it will be a big shot in the arm. And I will talk about the automotive sector a little bit ahead in the video. So I think we should, as we start entering the festive season in October and November, in my opinion, we should see some small stimulus, which is going to be very, very important in order for us to recover from the 24% contraction that we saw in GDP, in the first quarter. But as I said, markets are forward looking, and markets have built on the gains of June, both in July and August, by smartly going up, and the breadth of the market also improved dramatically, which has brought a big question back into the minds of investors: that are the markets expensive, right? And obviously, the parameter which is most talked about when we talk about valuations in markets is the PE multiple. And therefore, if you look at the Nifty valuation, and I've shared a chart with you, which probably you can see on your screen, that the forward Nifty multiple is now closer to 28 to 29 times. And we all know that all the previous peaks in the markets have happened whenever multiples have been in excess of 22 to 23 times. And that starts to bring fear into the minds of investors that has the market become very, very expensive. And I think that we need to examine this question with a little bit more context. One is that if you look at the Nifty chart that I've shown, we have also calculated the 5-year rolling average PE multiple of the market, right? And the reason why we did a 5-year rolling multiple is that it kind of smoothens out any short period where the earnings multiple would spike. And if you see, the 5-year rolling average multiple has been consistently going up in India. And if you look at it, ever since 2005 up until 2020, the readings on the 5-year rolling multiple has gone from 14 to almost 23 times, right? And what it tells you is that the P of the market has been consistently going up, especially the 5-year rolling multiple has started to move up post 2014-15. And if you look at the graph on the right-hand side, we have plotted the 10-year GSEC yield, which is in many senses tells you what the interest rate or the cost of capital in the economy is, right? And if you see that consistently over the last few years, the average GSEC yield, which used to be in the range of 8 to 9%, has now fallen to a range which is between 5 and 6%. So we have almost seen a 300 to 400 basis point fall in interest rates, in long-term interest rates in India. And as we all know, that the relationship between the PE multiple and interest rates is inverse. So as interest rates fall, as cost of capital fall, all assets have got repriced. And this is just the Indian context. We all know what has happened to global interest rates. And as a result of almost zero to negative interest rates that we are seeing globally, all asset classes and especially equities have repriced themselves. So I think one of the reasons why PE multiples are higher is because we've consistently seen interest rates come down. Secondly, we must also be careful when we look at PEs, is because the other variable in the PE is the earnings. And we all know that the FY21, the earnings are going to be significantly impacted because of the COVID crisis. And therefore, optically, the PE ratios would look significantly higher. And therefore, if you have to talk about valuations, it is important that we look at other ratios as well when we talk about valuations. And what we've done is that if you look at the price to book chart, right? And if we've again done a 5-year rolling price to book chart, and you will see that on a price to book basis, we are still at 2.9 times. And if you looked at what the price to book was, let us say during the peak in 2008, we had almost reached a price to book of 5.5 times, right? So while on a PE basis, we were 23 times in 2008, and we are currently 28, 29 times. But if you look at a price to book basis, we are well below the number that we were in 2008-9. And then if you look at another valuation parameter, which is a very good indicator of the aggregate valuations in the market, is the market cap to GDP ratio. And again, if you look at the chart here, you will see that in 07-08, our market cap to GDP had reached 170%. In September 10, it was at 119%. In early parts of 2017-18, it was at 100%. And now we are at almost 70%. So if you look at a market cap to GDP, we are like, we were at 170% during 2008-9, and now we are at 70%. So if you don't look at just the P, but if you look at either price to book or market cap to GDP, I think the markets are not horribly expensive. I would say that they are fair, but they are by no reason we are in a bubble. There is another variable, which is the EV to EBITDA. And we were at 18 times EV EBITDA in 2008-9. We are now at 12 times EV EBITDA. So I think it is very, very important to understand that while the markets have come back up very dramatically from the lows, and there is a lot of, should I say, worry about market valuations, in our opinion, while markets are fairly priced, but they are not definitely in the kind of bubble zone, given the fact that people have started comparing the current situation to 2008-9. The second thing that I would like to talk about, and this is something that, I have written before and spoken to you, and people say, is that market leadership, right? Every time you have a bear market, and the definition of a bear market is any correction which is over 20%. And in March, we had a correction which was more like 28 to 30%, the markets corrected, and we went into a bear market. And since then we've come back. But every time there is a significant event which changes the course of the markets, leadership also changes. And this time is no different. And therefore, what we have done is that we have looked at the sectors and their performance both over the last 1 year and since the bottom of the market in March to, let's say, end of August 2020. And this is an exercise because this tells you something. The market, in its own wisdom, tells you which sectors are likely to do well or have done well, and it tells you where to focus on. And sometimes it's very, very interesting reading to see how sectors have performed, post the crisis. And if you see this table, you will find that the pharma index is by far the best performing index, not only since the post-COVID recovery, but also if you take a 1 year period, the index is up 42%. And since its recovery from the lows, it is up 72%, right? Followed by pharma is autos. And this is surprising because most people felt that autos is a consumer discretionary sector. The general perception was that who's going to buy an automobile when there is so much of uncertainty about incomes, about jobs, about salary cuts, so on and so forth. But if you look at it from the lows, autos have done phenomenally well. And I would say that there are two reasons for that. One is that in response to the crisis, one of the things that the RBI has done is to infuse massive liquidity and drive down the bond yields or interest rates. And one of the most sensitive consumption sectors to interest rates, other than housing, is automotive. And that is one reason. Secondly, we must also understand that autos were anyway a very, very challenged sector even pre-COVID, right? Last year, automotives, the industry continued to do badly because there was the BS4 to BS6 transition, which was going to happen. And therefore, there was inventory which was being run down. Secondly, there was a lot of policy flip-flop by the regulators with respect to electric vehicles, whether the ICE engines will be banned after a period of time, and therefore consumers pulled back and did not invest. And then also because of the general challenges post the IL&FS crisis with respect to funding of NBFCs. So all of this contributed to the sector not doing well in 2019 as well. And therefore, to some extent, the base effect is lower for the automotive sector. But it's quite interesting that a consumer discretionary sector has come up on tops, which is the second best performing sector from the bottom. The third is metals. Typically we know that whenever global interest rates fall down, commodities rally, and that is being reflected in the metal index. And the fourth one is IT, which is essentially, one of the beneficiaries of a post-COVID world as more and more companies decide to spend more on technology. So I think pharma and IT both are beneficiaries in the post-COVID world. Both are also reasonably defensive in nature. Businesses are high cash flow businesses. The FMCG index, while people would have said would be in the top, is not in the top, though it has done well both on a 1 year basis and on a post-COVID basis. But I think the starting valuations were significantly high there. And therefore, the FMCG business is not amongst the top. And as we have argued, the financial services, the PSU and the worst performing indexes are the PSU banks and the PSU index, and that is to be understood given the kind of challenges that both these sectors have seen. And I think the banks and financial services continue to be one of the laggard sectors, though many stocks have recovered from the lows. But I think between sectors, it is not one of the leading sectors. And that is something that we have been talking about, that, this sector is challenged largely because, once there is an economic contraction, there are likely to be a spike in NPLs. And because of the moratorium which has been put in play, there is uncertainty about the balance sheets or the opaqueness about the balance sheet. And maybe clarity on those aspects we will only get to know sometime, in my opinion, either after the second or the third quarter. And while the sector is recovering well, as most of the players have gone ahead and raised equity capital, but I think until there is full visibility and clarity, banks and financial services, especially the lenders, continue to be amongst the bottom performing sectors in the market. So I think, and then if you look at, in light of this, if you look at the actions that we've taken in our portfolios, as you know, that, one of the things that we've done is that, we increased our exposure to pharma, both API and frontline large pharma companies, including some mid-cap exposure. And we have also increased our exposure to communication or telecom services. While here, the Nifty Energy is amongst the top 5, but that's largely because Reliance is still considered as an energy company, while largely it's now a telecom play, and therefore we increased our exposure within financials to non-lenders like insurance. We've increased our exposure to pharma. We've increased our exposure to agri, though the agri index is very, very small, so it does not feature in this list. But that's what we have done, and we dialed down our exposure to the financial services businesses, and as you can see, that those are still amongst one of the laggards in the markets. So I think on the whole, as I said last time, we continue to remain cautiously optimistic on the market. The recovery theme continues to be played out in the markets. And right now, some of the laggard sectors, which were substantially impacted, like consumer discretionary, aviation, hotels, I mean, those stocks continue to do well because there is an expectation that as the economy opens up, businesses in some of those areas will also start to normalize. With this, I will sign off as far as the markets are concerned. I hope you found some of this data quite useful and interesting. And we will continue to talk about interesting aspects on how markets are performing, what they are telling us. And also we will talk about any significant policy level decisions which impact the economy and the markets as a whole next month. So with this, I sign off. Thank you so much for giving your time, and I wish everybody the best of health, and I hope all of you are doing fine. Bye-bye.